pre-LOI, ideally if possible, parts of, and I recommend trying to get the last 3 years of tax return along with the current P&L statement, current balance sheet, and then if there's loss of accounts receivable and loss of accounts payable on the balance sheet, a receivable summary that shows how current each of those are.
There's an entire generation of Americans who no longer care about prestige, titles, work travel, fancy offices, and lunches. Welcome to Mundane Millionaires, a podcast for this generation of small business owners who want to set their ego aside and focus on what matters: family, community, quality of life, and cash flows. In each episode, Eric Pacifici and Kevin Henderson uncover what it takes to get a little money in the bank, control your time, and invest in building great families and lives. Let's get started.
Kevin.
Eric, welcome
Henderson.
back.
Yeah, hey man, great to see you. Happy 2024.
Likewise.
For the audience's benefit, I think we talk about this, but first episode of 2024, first recording of 2024. I don't know, it'll be a first episode drop, but yeah, hopefully it's a step forward, not a step backwards. I think that's always the
I think
the goal.
I think we've got some amazing guests coming up, some great stuff planned, and we're kicking it off with none other than Pioneer
Matthias.
Capital Advisory's Matthias Smith.
Kevin, I'm trying to get 1% better this year. Is that how that works?
I
trying to have a year
don't
that's
think
1% better than last
I don't
year.
think you're supposed to focus on 1% for the entire year. I think
Is that a day or a year? I can't
I think
remember what the
I think it's supposed to be like a day or something and see the compounding effects over a year. I don't
feels like a lot. Feels like a ton.
1% for a year doesn't feel like a whole lot, conversely.
I think you'd be like a trillionaire if you did that in money. So
Fair.
I don't know.
Fair.
Feels ambitious. Yeah, Matthias, great conversation with Matthias. Matthias runs Pioneer Capital for, I think a lot of the audience probably knows Matthias or is familiar with Matthias, but he left corporate like many folks are aspiring to do, like you and I did, and founded his own firm. He's a tremendous success in SBA debt brokering. And I think he did somewhere in the neighborhood of like 50 million plus in transaction volume in 2023,
It's incredible.
which is really impressive for a one-man shop. And I think he said he's aspiring to do 100 million in transactions this year, which is remarkable. So I really grill him. I think we both do. We get after him about SBA financing, how to find a good lender, what you should be looking for, the typical terms, how to approach a lender intelligently, what you need from the seller, yourself, deal structuring, working capital. We talk about equity injections, where you can find the equity injection, what you need. I learned a lot, I think, about the SBA lending process and how buyers should be approaching lenders. What was your takeaway, Kevin?
100%. And it's so great to talk to someone like Matthias as well, who's outside of that sales seat, and, not to disrespect a lot of the direct lenders and BDOs out there, and the high quality ones really do have searchers' best interests at heart, but like functionally they are salespeople, right? And so to step back with someone like Matthias, who's not necessarily in that sales role for a specific bank, to really break down what can you do, what are the options out there if you shop to different banks and things like that, is just so helpful. I thought it was super informative and super insightful, just in kind of navigating the process and what is actually possible that you may not learn if you're talking just to like one discrete bank.
100%. Yeah, 100%. So great episode, Kevin. I think we should throw it over to Matthias and get 2024 rolling so we get that 1% cooking. Let's go.
All right. With that, we'll see you all next week.
Matthias, and he's on Mundane Millionaires today. Matthias.
This one's going to go viral.
Yeah, first episode of 2024. Happy New Year, fellas.
Happy New Year to you guys too. Good to be on with you.
Just so we don't confuse our listeners, Eric, first recording of 2024. Maybe not first episode, in case you're looking at the calendar trying to figure out what happened to the first few weeks.
It's good clarification, Kevin. Our listeners are an easily confused bunch, so I appreciate you making sure that
we got to break this down very, very.
We don't want anybody driving off the road or anything like that. But we have Matthias Smith, Pioneer Capital, in the house. Super excited to talk to Matthias. Matthias has been bird dogging this podcast appearance like nobody I've ever interacted with before. And so super excited to have him here to talk SBA lending and business buying. Matthias, you take us through your journey. Just give us kind of like the brief highlight. I think a lot of people who are listening are going to know who you are, but you were at SBA Lenders in a closing processing role. And then a couple of years ago, you started kind of doing similar to what I did. You started talking about business buying and, entrepreneurship through acquisition, SBA lending from a position of passion and interest on social media. And it kind of just took off. And you were in Greece, I think, a couple of years ago, and you shot me a note and you're like, hey, should I quit my job and start a firm? And
so
I was
this
like,
is your fault, Eric?
I was like, don't do anything hasty, Matthias. And then sure shit, here we are 2 years later, or however long, I guess, I don't even know how long ago that was. And you are now running a successful venture in SBA lending. So take us through the brief background.
Yeah, for sure, guys. Well, yeah, first and foremost, thanks for having me on. And I don't know if I had necessarily tried to bird dog this appearance. I think you wanted me on, Eric. And I just had more nudged the ball across the one. Kind of similar to how a defensive lineman pushes the running back into the end zone. But
yeah,
to your question,
sure.
Yeah. So
you just Blake Corined it, is what you're telling me. You just kind of powered it in. Okay.
Basically, Kevin. Yeah, so kept going back through the journey. So kept my background was working in SBA lending, worked at 4 different banks, was at Live Oak for about half a year back in 2021 as a closer, kept middle office employee, quarterback in the process from the time the deal would get approved up through closing and funding. And it kept everything involved in that logistical point in the process. Was also at Byline Bank for about 3.5 years, working with Tom Lyons over there and other people as well. In that same kind of closer capacity. And then also 2 banks based in Wisconsin, one based in the Milwaukee area called First Bank Financial Center, and the last one called First Business Bank based in Madison. And essentially, what brought me from working at these banks to going off my own was in March of 2022, the day that I had started at my last bank, First Business Bank, I got introduced to FMB Twitter from Scott Oliver at Lewis and Campus, who we both know by way of Twitter. He's bank counsel on lots of different deals that we do. So he shot me this note and said, hey, congrats on the new job, wish you all the best of luck and success. Hey, by the way, here's a space on Twitter of all these business buyers looking to buy these small to medium-sized businesses. You should put content out to network with these folks to try to generate deal volume for your bank. So right around that period of time, there's actually a lull in the pipeline of deal flow at my last employer. So I kind of took this as a battle cry of sorts to go out and kind of beat the drum to try to help curate and generate deal flow. And I basically, from all this content post that's on Twitter, threads and posts about business plans, projections, using a home equity line to keep your house off the SBA loan, things like that. And all these DMs start to come in from people looking to buy these businesses, looking for financing. I started then referring these buyers to my bank. And fortunately, halfway through the time at my last employer, in April of 2022, I made the mistake of retweeting a tweet from my bank, at which point in time my head of marketing, and shortly after my head of compliance, caught wind of my Twitter presence. And it kind of went down this rabbit hole of sorts where they wanted to raid in and kind of police my Twitter presence. And when I got to my 2-month review in May, it cascaded where I basically got told, you either had to get off of Twitter or stop posting about banking, SBA acquisitions, unless you want to kind of vet my tweets by the bank first. So at that point in time, I referred the $15 million of referral to my bank for potential deals. And right after the 2-month review, while on vacation in Greece, kind of like you mentioned towards the start of the discussion, Eric, I thought to myself, here I am generating all this inbound for my bank. They're really forward thinking about this. And I'm basically getting told to remove myself from the sales funnel, which didn't really make any sense. And I thought, I've worked at these 4 different banks, Live Oak, Byline, and these 2 other ones. I've kept in touch with the lenders that I've worked with as they've gone from one bank to the next to basically keep tabs on the different underwriting requirements, industries they're financing deals in, debt service coverage requirements, things like that. And then lastly, these banks in the SBA lending space, like First Bank, the Lake, Byline, etc., will pay referral fees to firms like mine to send deals to them. So I thought, here's a conversion to the market, i.e., SMB, Twitter, LinkedIn, and similar. My skill set and a revenue model. Why not keep formulated business around this and go out to help these business buyers go from point A to point B?
What do you think it was, Matthias, specifically that had the bank uncomfortable? You mentioned the head of compliance. Is there some regulatory concern? Like, let me pause. I'm thinking about like capital raising and securities offerings and things like that, right? I mean, there's regulations about what you're allowed to say publicly, when you're allowed to say it, how you're allowed to say it. Is it similar with banking? Like, is that what was going on in the background here, or do you think this was something else as sort of cover to hold you back from the type of business you were developing? What do you think was going on there, actually?
Yeah, great question, Kevin. I think there were kind of two different things going on in parallel. So the first being with the compliance side, some of these posts like me explaining how to use a home equity line to keep your house off the collateral for the SBA
Yeah.
loan. I think that they were kind of worried about that from a compliance standpoint. If someone went and pulled one, and then the bank required a lien on their house, that would come back and cause issues for them, whether it be someone doing a deal with First Business Bank or a different lender, like a Byline or a Live Oak or someone else.
So maybe some of the advice they were thinking was running counter to the bank's interest. Like you're advising people how to bring us a worse collateral package, sort of.
Yeah, more or less. And then kind of adjacent to that, to the other question, I think part of it also had to do with the fact that they were worried that I was kind of spinning up my own thing, which honestly wasn't the intention at the time.
Yeah.
And they kind of saw me building a vertical of my own of sorts that I think they want to have control over.
Yeah. Interesting. Did you ever consider approaching them and say, hey, I don't want to, like, I'm sitting on this asset. I don't want to close the loans anymore. I want to be a BDO and look how much business I can drive. Did that enter into the calculus at all? Or once you had the review, you were kind of like, I'm done with this?
Not yet. That never really kind of entered to my mind, just because I sensed the conservatism at the institution kept leading up to this, in comparison with, institutions where like Ray at FundX works or even Tom at Byline. And it just didn't seem like an institution that would be congruent with what I wanted to do.
Yeah, that's fair.
So Matthias, you go down this journey of entrepreneurship. You rip the Band-Aid off, you quit your firm. You had the benefit of having a meaningful social media following at that point in time, which a lot of people don't have. Tell us about the experience of transitioning from corporate guy working for a bank of all places to now being, a lone wolf out here originating business primarily from the internet.
And specifically, how terrified were you? Eric has publicly shared his story several times of standing in the shower, literally this like one moment where he's like, holy shit, this is either the best or absolute worst idea I've ever made in my life.
Naked and afraid.
What was that? What was that moment for you? Did you have that moment? Anyway, tell us about that journey.
So the kid at the point in time, so basically I kept walk through and give the people watching this like the backstory. So I was in Greece, and basically the night before I put my nose out, I kept boozing up with my wife. It was like right after catamaran cruise.
What were you drinking?
It said like it was something of red wine. Yeah,
details matter. Those good Greek red wines. They're well known.
It was very good Greek red wine. It said, "Hey, I'm gonna quit my job tomorrow." So I got my phone, sent an email to my boss, and the managing director of the SBA division there, that I think either was fired or got let go shortly after this, but not directly related to my story. But anyways, so I sent this notice off, and I thought to myself, I'm gonna give this 6 months. I'm going to see if I can build a business doing this. If not, I'm going to go back and try to get another job and hope that a bank doesn't look at me as too much of a maverick, that I can actually get gainful employment somewhere else. So
Can I pause you there for a second, Matthias? You're on vacation with your wife and you literally email to quit your job. What's your wife saying to you about this? 100% supportive, all in? Is there some trepidation? Is she like, Matthias, are we sure? Like,
yeah, she's kind of shitting herself over it, to be honest.
Okay.
But
no, I mean, this is important. So many entrepreneurs out there have a spouse that we don't talk enough about, like how important that is to have on board. So I'm genuinely curious how that conversation went with your wife.
Yeah, no, so she was kind of shitting herself over it, but I said, hey, this will be fine. I have a couple $100,000 saved up. If this doesn't work out, like I can float it and things will be fine. Is basically what I said.
Yeah.
So yeah,
do you think you're employable now, Matthias? Do you think you can go back now? You think
I would not hire myself. I think I honestly would not hire myself, Eric. I think maybe,
to be fair, I wouldn't hire Eric. So there's that.
What about me? Would you hire me, Kevin?
Oh hell yeah! You could drive some business and engagement. I love it.
Yeah,
I got as an aside, guys. I got a text yesterday from a head of a practice group for a prominent DC firm who I'm friends with, and he texted me and he said, "Let me pull it up here." It was one of the nicest, but funniest things anybody's ever said. He said, "Your talents were so wasted as a law firm associate," and I thought that was nice, but it was also like a little like, "And you're never coming back to Big Law, so good luck out there."
I don't think I'd hire you, Eric, if I was the head of a capital markets team at Kirkland Ellis or similar. I think you're unemployable for life at this point, honestly.
Thank you, Matthias. I appreciate that.
Take it as you may.
I won't think about that.
Yeah, Kevin, back to your. But yeah, back to your question, Kevin. Like the first 3 to 4 months was just me like pounding the pavement. So like reach out to people on Twitter, some of whom have DM'd me up to this point in time, posting like, "Hey, I've started this loan brokerage firm. I'm basically gonna help you as the buyer, find the right bank for the financing," and just pounding the freaking pavement more or less on Twitter, reaching out to lenders I'd worked with, like people like Tom Lyons, Rager, and others to get hammer referral agreements with them, and basically just trying to get my name out there, just constantly freaking pounding the pavement. And it wasn't until mid-September of 2022 that I closed my first deal. And I think the commission from it was like $10,500. So I went from like a byline when I left, and it was end of March or April 22. I was at 95. Then I took a pay cut to go First Business Bank. There's a long story there, Kev, not relevant to this. I was at 88,000. And then basically from that point when I got my last paycheck in May, no money in the door up until September at like $10,500. So
at this point, your wife is like, "We've made a terrible mistake," and my wife is more conservative than me, and like from a financial standpoint, I mean, she's going to be a W-2 employee her whole life unless she decides to quit, which she could if she wanted to. But irrespective of that, yeah, she was worried. So basically, I was communicating constantly as the pipeline was building. Here's what's likely going to close. Here's when these monies will come in. Things will be okay. Things will be fine, essentially.
Yeah. And how long did it take after the commission started rolling in for her to come around and be like, "Wow, this is incredible. Good job." Like I assume at this point, she's 100% behind you, loves what you're building. I don't mean to harp too much on the dynamic with the spouse, but I know it's something so rarely talked about.
Yeah. It was about 3 to 4 months, like shortly after that, where she saw things continuously coming into the pipe. Like, I mean, I wasn't sharing forward names or anything like that, of course, but just like, "Hey, this is how much I'm gonna make when this closes." Things will be fine. So
we've talked for a minute about your spouse. Like, what about yourself, Matthias? Did you have that moment between quitting in April and September where you were like, I mean, you're just stressed, you're not sleeping, you're pulling your hair out, you're like, "I've made the worst mistake of my life," or did you have all the confidence in the world that I just need to put in the time, this is going to be 100% successful. Like talk about that.
Yeah. It was honestly the former. I mean, I'd be bullshitting both of you and the viewers a little later. And I think it's the former for most people, honestly. Like, there were nights I woke up that I'd stare at the ceiling and I'd be like, fuck, was this the right move or not?
Yeah.
So.
Yeah, no, it's tough. I mean, we've talked about that. I mean, we had every indication in the world at the start, similar to you, that the business was going to come, just by the sheer volume of DMs and stuff. But it doesn't, until that cash flow is like really moving and building, it does not take the stress away. That's, to be out there on your own without the safety net of every 2 weeks, you're getting that direct deposit.
Right. And another point too, like, as well as like, with firms kind of like our business model, right, being like service providers, project-based revenue, it's not like, you own like a business of contractually recurring revenue unless you're doing external ongoing legal services and or advisory work. So it's like every deal is literally its own cash flow. And then between the time you sign up a deal and between closing, there are 110 things that could go wrong that could derail it.
Yeah.
It's project-based revenue, and it's inconsistent and unreliable project-based revenue. So it's fascinating. And let's talk about that, Matthias. Let's talk about SBA lending, because obviously your expertise at this point, is in a variety of areas, I think, with small business acquisitions, but SBA lending is what you do. And I think a lot of people listening to this are going to be curious about SBA lending. I remember reflecting a couple years ago when I was introduced to entrepreneurship through acquisition and small business buying, and learning about, like, where would you get the capital to buy a business? How would I get the down payment, collateralized loans versus, cash flow based loans? I think that's a big misconception for people who aren't familiar with the space. And then ultimately, I think the biggest hurdle for a lot of people is the equity injection piece. So let's kind of talk, let's unpack SBA lending, Matthias.
Should we start with equity injection, or where do you want to start, Eric?
We can, but I think let's think this through logically. I'm a buyer. I want to buy a small business. I, have found one that I think is attractive, and now I'm approaching a bank for the very first time, or a broker for the very first time, to try to figure out how to get the capital to do that. What's the first step for somebody who's completely green, has no exposure to SBA lending, to kind of put themselves in a position to go get that debt?
So at the point in time you have a deal that you and the buyer plan to pursue, you want to have the financial package of your personal financial information, the seller financial, and then basically have a source and use modeled for how you're planning to, how much SBA financing you're looking for, seller financing, down payment funds, and where the money is going.
Got it. So let's take those one by one. So the first thing you mentioned was the seller financial statements. What type of financial statements do I want to request from the seller, pre-LOI, post-LOI, whatever, at any point in time, to go to the bank with the right documents to start the financing process?
Yeah, so pre-LOI, ideally if possible, hard to obtain. I recommend trying to get the last 3 years of tax returns along with the current P&L statement, current balance sheet, and then if there's lots of accounts receivable and lots of accounts payable on the balance sheet, a receivable summary that shows how current each of those are.
Got it. And in your experience, is that something that sellers typically have? I'm a buyer. I say, hey, give me 3 years tax returns, a P&L and balance sheet, and a AR and AP summary to determine the currentness of it, and they're able to fork that over? Yeah. How does that process usually go in practice?
It honestly depends on how far at market the deal is, the sophistication of the broker, and how good quality the financials are for the seller. Like, most sellers honestly aren't going to have AR and AP agings readily available. They're going to have to ask their accountant to put those together. On tax returns, if you're dealing with, a very competitive deal, one lets it by an investment bank or someone like a Clint Fury on Twitter, good luck getting the tax returns. It's going to have to be like more of a mom and pop type broker to get those pre-LOI.
Got it. Okay. So, but essentially you want to have a good summary of the seller's financial situation, 3 years of tax returns, And are we now exiting out of kind of the COVID year tax return issue that we had 2 years ago, where it was like, okay, some of these are massively inflated, some of them are massively deflated. Have you seen that kind of age out, or are we still dealing with that?
Yeah, so we're basically at the tail end of that at this point in time because now, from a financial standpoint, banks are going to be looking at 2021, 2022, and 2023, whereas before last year, 2020 was still getting listed, but most banks are carving that out and just kept asking for what the impact of the pandemic was in the business.
Yeah, and are we finding that the 23s effectively, if I'm going to do a deal now in 2024, I need to have my seller needs to have their 23s done in order to get through underwriting?
Yeah, so if this was a process, banks aren't requiring a 2023 tax return yet, but they're asking if it's available. So, like most of the banks that I work with, they're wanting to see the full 2023 P&L, and then also wanting to know, like, if the valuation of the business in the underwriting of the buyer on the deal, basically, if the deal penciling hinges on the 2023 numbers, the banks are wanting to see the tax return. If it works in 2022, in 2021, or in 2022, they aren't pushing for 2023. If the answer is the question.
It does. It does. And so they're able to kind of think through a little bit more critically on debt service coverage ratios, which we could talk about, and then also valuation metrics and what they expect. So it doesn't necessarily have to be hard and fast. I need 2023s. It has to pencil out 2023. They're kind of able to think through.
Correct. Yeah.
The second thing you mentioned, and Kevin, feel free to jump in here, but so seller financing, and then you mentioned organizing the deal. And you used an expression that I want to unpack, which is sources and uses. Think through the sources and uses, kind of the structuring and the seller's contribution to the deal. Talk about the typical deal structure that you see, and then tell us what sources and uses is.
Yeah, so as far as kind of typical deal structure, I would say generally speaking, I see most banks lending anywhere between 80 to 85% of the total project cost. So basically taking the purchase price of the business and then adding in all of the other stuff being financed. Then generally speaking, the seller having a seller's note with payments on it out of the gate for somewhere between 5 to 10% of the total use of the funds. And then the last the last 10%, the equity injection or the down payment, what it's also called, either coming from cash from the buyer into our investors or being some combination of cash from the buyer and investors coupled with standby seller debt. So a seller's note that either has no payments on it for the first 2 years and then payments in year three through year 10, or the classic trademark now full standby seller's note, which is the seller's note that has interest only accruing year one through year 10 with no payments until the SBA is paid off.
Okay, so just to summarize, so you're saying typical purchase price, 80 to 85% is being financed through the bank in the actual total project cost, which is your purchase price plus the other stuff that's being financed. What other stuff is typically financed in that 80 to 85%?
Yes, the other stuff being financed, Eric, is the permanent working capital. So basically cash that you need to run the business that you're getting from the bank financed into the SBA loan, of which the amount just depends on what you need. The closing costs for the bank, so basically the bank attorney fees, due diligence searches, appraisal, things like that. The SBA guarantee fee, which is essentially the equivalent of private mortgage insurance for taking an SBA loan. And then also whatever your attorney fee is, like you guys take, for example, and or the financial due diligence costs if you're getting a quality of earnings report to validate the financials, which I almost always recommend.
What's the most common stuff you see when searchers come to you that they're missing, that they're not thinking about or not remembering or not appreciating as an expense that they need to account for in the sources and uses?
Yeah, so honestly, Kevin, it's across the board. I've seen some people that don't know you can finance working capital into an SB loan, which is honestly more of a rarity. But I've seen a few of those recently where that's not good for. I've seen other people where they have a super low number for bank closing costs, like $5,000 or something
Oh,
similar,
okay.
and they're kept under budgeting there. Or someone where they're buying, let's say they're buying an HVAC company, they're planning to do it as an asset purchase, and there's 15 vehicles or 10 vehicles, not accounting for what the vehicle transfer taxes are going to be. So all different things across the board, honestly.
Got it.
Let's make it a point to come back to working capital, because I want to unpack that a little bit more and think about the difference between the SBA Express loans and then what's typically kind of in that total project cost working capital. So that's interesting to me. But you also mentioned the guarantee. So SBA debt, for the audience benefit, is guaranteed or supported by the Small Business Administration. The debt itself does not come from the Small Business Administration. It is back. The banks lend them individually, and assuming that the bank adheres to the standard operating procedures of the SBA, then the SBA will support that debt in the event of a default. And typically, I think the percentage, and I always get this wrong, I just need to write it 5 times, but it's like 75 or 80% of the total loan amount that they'll actually backstop, assuming that the lender does it correctly. We could talk about, lending guidelines and how everybody kind of does it a little bit differently, but the lender pays a fee to the SBA to support that guarantee. That percentage just recently changed, Matthias. Tell us what the SBA guarantee currently is and what percentage of the deal you have to pay.
Yeah, so the SBA guarantee fee percentage, unless it's a really small loan in the couple hundreds of thousands, is almost always going to be 75%. So if you're taking a $1 million SBA loan, the government would insure 75% of that. That's the portion the bank can either keep on the balance sheet or sell in the bond market, not to go down any rabbit hole. And then the other 25% is unguaranteed or not insured. And that's the part that's the capital at risk for the bank. Now, if you're a buyer, say buying a business that does international trade or international sales, like right now I'm working with someone that's buying a business that sells products to Canada. If you can prove in your business plan that you're either going to sustain or grow that international sales after you buy the business, then the bank can get a 90% guarantee and their credit exposure goes down from 25% to 10%.
But not from the, I care less about the bank's perspective. I'm more curious from the buyer's perspective. What amount, what's the amount of the fee that you pay to support that guarantee?
It's proportional to the loan, Eric. So there's a formula on a spreadsheet on the SBA's website. It changes, it varies based on the exact loan amount. Off the top of my head, I honestly can't remember the formula.
For the audience's benefit, there is a calculator that's available online in Excel spreadsheet formula. So if you want to get the specific amount of the SBA guarantee fee for your purposes of your transaction, you can calculate it to kind of try to run the numbers and budget. But suffice to say, Matthias, sounds like the upshot is that can be financed in your sources and uses. So you're not necessarily paying out of pocket. Your equity injection, which again has to either be 5 or 10%, depending on the lender, is adjusted proportionally.
Just to pause there for a second. The 5% or the 10%, that's no longer a thing, Eric. So there's no longer a minimum cash floor that has to go into the deal for the audience's benefit and for the editorial notes. There's now essentially the SBA did away with the minimum cash floor. So the cash or the 10% equity injection can either come from a combination of cash or the full standby seller's note or the partial standby seller's note. One of those 3 things. The minimum cash floor is now lender discretion.
So in theory, Matthias, it sounds like you're saying you can bring nothing to the table cash-wise and have the seller finance the full portion of the equity injection. How often are, number one, I don't know that I would recommend that. Just caveat for our audience's benefit. Yeah. Obviously, the more debt you take, whether it's in the form of a seller note or a SBA note, you're higher leverage, higher risk. So something to be aware of. Not financial advice, not a financial advisor, but something to think about. But what you're saying is the SBA itself is saying you could theoretically bring 0% to the table and the bank could approve it in accordance with the SOPs. But what are you seeing the banks actually do? How many banks right now are saying, hey, great, you got 100% leverage in the form of 90% SBA, 10% seller financing, we'll approve that?
Yeah, phenomenal question. So most 90% of banks that I work with want to see the buyer group, meaning like the operator and or investors collectively, bring a minimum of 5% cash to the deal proportional to this whole project cost. So basically, half of the 10% equity injection. I had one deal that was approved that sputtered out and died due to the seller canceling the transaction, where it was a 23-year-old buyer buying $1 million landscaping company. And he was going to put 5,000 of his own cash in, and the rest to get the 10% down was going to come in the form of the 24-month partial standby seller note. But from the lenders that I know, Eric and Kevin, they're all only wanting to see the no capital in to the deal for the key employee buyout type deal. So, like, say you, Eric, work for Kirkland Ellis and are looking to take out a $5 million SBA loan to buy Kirkland Ellis, which wouldn't get you there for what you needed. But basically, assuming that you could buy it for a valuation where it would cash flow accordingly, that's a transaction most banks would consider with no capital in.
Understood. So it sounds like if you are planning to buy a small business, you want to be thinking about having at least 5% of the purchase price of that in the form of cash. What if I don't, Matthias? What if I don't have any capital to bring to the table? What are the options that you're seeing in the form of investors and other ways around to get the get the deal done, but without bringing a full 5%? Or I don't suspect that there's anybody who's going to be able to buy without putting any skin in the game. If I'm an investor, even, I'm probably not gonna back somebody who doesn't have anything put in. But what are you seeing as workarounds through investors or otherwise?
Yeah. So lots of searchers out there, many of whom I work with, and similar ones that you guys work with as well, will do the equity raise for their deal. So they'll basically go out to either a combination of friends and family, professional colleagues, or now there's honestly a pretty big community of self-funded search investors. And for the viewers watching this, self-funded is kind of a misnomer because it means that you're self-funding the down payment, but lots of essentially SBA finance deals. There's a huge network of people out there on platforms like Search Funder, SMB Junction, and otherwise that will invest in these deals where buyers are seeking an SBA loan. So generally what I tell buyers is if they have a deal where it's a good industry, they can put together a good business plan explaining how their professional skills are transferable to the business. And if they're offering favorable investor terms, they'll be able to find the capital out there.
So Matthias, I go out to the equity investors that you mentioned through whatever means. They say, yes, I'll give you the full 5% for the down payment. So I've got 5% coming from equity investors. I've got 5% coming from the seller, and then the rest coming from the SBA. Is that done deal, or do the banks have issue with that construct as well?
Lots of the banks that I work with are fine with the whole equity raise coming from investors and don't have a minimum that they want to see from the sponsor or from the person buying the business operating it. There are a handful that want to see capital in from the personal guarantor from the buyer, but that's a bank specific requirement, not an SBA mandate.
Got it. Okay. Interesting. So the last piece of it that you mentioned is the seller financing. So you said, I'm a prospective buyer. I approach a bank. I've got the seller's financials. I've got the deal structured. Sorry, not the seller's financials, but my own personal financials is the last bucket. I approach a bank. What do I want to have lined up? What do I need to show them? What are they going to care about in terms of me as a buyer?
Yeah, so I'd say the most important thing, or one of the most important things, is your resume and essentially kind of what skills you as the buyer bring to the table. So, for example, are you coming from like a finance, investment banking, consulting type background, where essentially you bring those strategic financial planning, kind of capital allocation, and/or just strategy skills to the deal? Are you coming from an ops background? Maybe you've been a GM at a company before. You've managed people, you've managed teams, you know how to work with people and how to lead teams, things like that. I'd say the resume is one of the top two most important things. And then, Kevin, adjacent to that is going to be your personal financial statement. And for the banks that want to see capital into the deal from the buyer, essentially after you've put your capital in as the buyer, how much do you have left over in post-closing liquidity? So specifically, how much cash you have left in the bank after you've made your portion of the down payment, because they don't want you to be kids stuck out in the streets and not able to afford your fixed expenses.
Yeah.
And so if I'm a typical, guy or gal that's worked in corporate for a decade, my personal financial statement looks like, maybe a couple $100,000 saved up in, a 401k, some meaningful amount of cash. I've got a house that's got, a few $100,000 in equity. Is that enough to get the deal done? Do they look at this, the retirement accounts and the home equity and say, hey, this is going to, provide you, Mr. Buyer, with sufficient cash reserves in the event of a crisis, or do they really care about post-closing? Like, what's the best way, assuming that you're not a person that comes from a wealthy background, what's the best, and let me phrase it like this. If I'm starting from scratch today, and in the next 5 years, I want to buy a small business and I want to position my balance sheet reasonably with what I can do over the next couple of years, what would you advise somebody to do? How would they structure that?
Yeah, so my recommendation there, Eric, and great question, would be to not have all the liquidity tied up in your retirement, because that essentially limits you to being able to do like a Roth or Bourses, what they call it, where essentially you're using the equivalent of like a retirement special purpose vehicle to buy the business, which limits what you can do as far as entity structure. And there's cost and tax implications on that front. And then if you wanted to basically pull funds out of that, and this again is not retirement or tax advice, it's not a CPA, financial planner, or similar, is there's going to be tax implications associated with doing that. So back to your question, I would say, have a good chunk of that liquidity in either cash reserves or taxable brokerage funds versus just all in retirement.
Okay. Got it. So Matthias, I've done all this. I've got the seller's financials. I've got a well-structured deal. I've got my personal financial statements lined up. I'm under LOI, and now I'm looking for a bank. Where am I going? What am I looking for?
Yeah. So if you're doing this kind of on your own, I mean, my top recommendation would be to go on Google and type in top 100 nationally ranked SBA lenders and look through that SBA lender rankings list to do your initial scrub of diligence as to which players are kind of bigger ones in the market. And then from there, kind of do your outreach directly after doing your own research as to which ones of those are established players in the search fund kind of business buying space. And it looks like you're pulling your screen up here, so I'll just...
Yeah, and for the audiences, those who are listening, I've got on the screen here. I googled, like Matthias said, top 100 SBA lenders, and it looks like
Go
I found
to the SBA website link directly. Yeah, that one there.
Lender reports. Okay, so SBA.gov/partners/lender/lender reports. 7A and 504 lender reports. And cutting to the chase for the audience's benefit, the acquisition financing through the SBA is the 7A product. The 504 product is a similar product, but it is used for acquisitions in the real estate space. So I assume we're clicking the 7A and 504 reports. And now, what am I looking at here, Matthias? It's going to tell me who I do and don't want to work with.
Yeah, scroll down a little bit there. So basically, Eric, what you'll see here is, or scroll back up towards the top. Essentially, think of this, viewers watching this, as the equivalent of a scoreboard for deal volume, right? So which banks are doing the most transactions or the most deals in the FBA space? And then adjacent or kind of related point to this is looking at the average loan size column. And of the deals these banks are doing, what is the average kind of deal size, right? So if you're buying with these businesses, generally speaking, lots of these deals are going to be kind of close to, I'd say, at least the average loan size of $1 million. It's pretty typical in the space. So if you're looking down this list and you see banks kind of doing larger deals, those may be ones to gravitate to, or ones that are going to be because they're suitable for you as a buyer, versus banks kind of doing smaller deals or maybe doing working capital.
Okay.
One relevant comment to this is sometimes with this list, some of these banks where the average loan size is higher is doing parts of the fact that they're doing lots of commercial real estate deals. So real estate, generally speaking, say you're financing a hotel, it could be a couple $1 million. So that can skew the two. So those banks, not all these banks that have the larger average loans are doing these cash flow search fund deals. Some are doing commercial real estate deals. So essentially, for the purpose of the viewers looking at this, initial task should be kind of looking at the SBA lender ranking. Second task should be the average loan size. And then from there, figure out which of those banks, the higher average loan size, are doing search fund deals versus commercial real estate acquisitions and similar.
Got it. So it sounds like the upshot here is I want a bank that does a lot of 7A acquisition financing in the search space. And I can surmise that by looking at total amount of deals done. And then I can kind of vet out who is not doing acquisition business buying finance by looking at average loan size. And then once I've got banks that do a lot of total deals and a lot of larger acquisition financing, then I can kind of do an individual deep dive on those and make sure that those are players that are actively involved in the search space. And it's interesting. We see a lot of familiar names: Live Oak Bank, Byline Bank. Who else is on here? Who else is on here that are major players, Matthias? And feel free to.
Yeah. So like First Internet Bank on there is a pretty major player. If you go down further on the list, you might have to scroll the notes a few times. You'll see our friend Ray Drew with FundX Solutions, and then kind of various banks gathered throughout this list. And I have to be careful not to give up too much of my secret sauce here. But yeah, there are some pretty good search fund players here on this list as you scroll up and down.
Got it. So then I approach a bank, and obviously, you as a broker, you are a solution. I'll just give you a quick plug. Matthias is a tremendous business broker. There are a lot of great banks, but you can obviously approach Matthias, who can help you through this process. And then the fee, my understanding, this is not a commercial for Pioneer, but just by way of background, since you're on the call here, there is, the fee that would be associated with you being a liaison for the process is then paid by the bank. So ultimately, you don't have to do all of this. It's just good background.
And just one correction is loan broker, not business broker. When you
you did say business broker.
Oh, I would never besmirch your good name like that, Matthias, by referring to you as a business broker. But
and just to, before you move on from that point, just to contextualize, and again, not to give away the secret sauce, so feel free to give a range, but like how many banks do you look to or look at working with, etc.? Like if a searcher comes to you, are you looking at 2 or 3 banks for them? Are you looking at 15 banks for them? Contextualize for listeners the benefit of going with a loan broker over direct to the bank and how much kind of legwork that saves.
Yeah, so it depends. So based on the deal structure, the industry, and like the debt structure, so like what percentage of bank financing the buyer is looking for relative to the total deal size, those factors could impact how many banks would be a good fit for a deal and how many would be a good fit to finance it.
Okay.
So for some deals, it might be as low as 3 or 4. If someone's looking at a deal where there's 90% financing ask, 1.15 debt coverage, and they're looking to do the full standby or the partial standby for part of the equity stack.
Yep.
If it's a deal where it's like 75 to 80% bank financing, 1.3, 1.4 debt coverage, good industry, recurring revenue, not project based, that could be 10 to 15 different banks of possibility.
Got it.
And let's pause for a second. I want to talk about debt service coverage ratios because I think that's interesting. But let's talk about what we're looking for. Obviously, we now have looked at the list. We know who does a lot of these deals, and so we can kind of, I guess, surmise. And maybe this is not necessary after we've looked at this list. But I'm looking for a lender. I'm going to buy an accounting firm, right? That accounting firm doesn't have any collateral at all. It's got contracts with customers, it's got employees, and it's got a name that's existed for a decade plus. That's literally all it has. How do I go and get that financed if there isn't any collateral for the lender to place a lien on?
Yeah, absolutely phenomenal question, Eric. So the banks in the search fund space are focused first and foremost on the cash flow of the business that you're buying. And essentially, if there's going to be enough cash flow to repay the debt based on the deal structure that you as the buyer are planning to utilize for the business purchase, if that makes sense.
It does. It does. So one of the things that I think is interesting about this, and one of the guardrails that I think is in place that not enough people appreciate, it's not talked about enough, is that a really good SBA lender has seen thousands of deals. I mean, more than that. They've seen, they look at deals all day, every day. They know what a really good deal looks like. They know what a good business looks like. They know what a qualified buyer looks like. And so I always tell my clients, I'm like, hey, there are about 5 or 6 people that you would want to realistically talk to. And if all 5 or 6 of them say, hey, no, I'm not going to give you the money for this, that should be a pretty good message to you. So one of the things I think is interesting is that the cash flow lender, as opposed to a collateral lender, there are some collateral SBA lenders that will say, hey, you've got, a bunch of equipment. So what do we care if you're qualified to buy this business or if it's a good business? We're going to put a bunch of liens on the construction equipment. And if you don't pay the debt back, we'll sell the construction equipment. So who cares? But the rest of them that understand that these are most of the time asset-light businesses that don't really have any stuff, they've got to actually look at the business and say, is this business and this buyer going to be capable of paying me back through the cash flow? And so how many collateral versus cash flow lenders are out there, Matthias? And do you ever work with collateral-based lenders? And in what situations do they make sense, if so?
Yeah, a true collateral lender, would be like an ABL, like asset-based financing type lender, where you're getting leverage or financing against accounts receivable, inventory, things like that. My comment on that, Eric, would be so the true cash flow lenders are ones that will go up to the full 5 million or stretch above with the SBA and do the SBA plus conventional structure, and they're focused really solely on the cash flow of the business that you're buying. There are some banks where in their credit guidelines, they have a maximum unsecured exposure amount that they can't stretch above, maybe say 1.5 to 2.5 million. And that's just give it a truly arbitrary bank credit exposure guideline prerogative or requirement. And I don't know if that really answers the question, but the vast majority of banks I work with will go up to the full 5 million.
So, Matthias, you mentioned the $5 million cap. And for the audience's benefit, in most instances, SBA lending right now is capped at $5 million in total lending. Is there any exceptions to that, Matthias? If I want to buy a $6 million business, am I capped at $5 million, or are there any workarounds for that?
Yeah, so there are 2 different workarounds, Eric. So one is there are some banks that will do the SBA 7 to 8, so up to the 5 million plus what's called a pari passu structure. So basically they'll do conventional debt over and on top of the 5 million. The banks that will do that are kind of more limiting, so there aren't a whole lot of them, but they're out there. So that's one option at your disposal. When you go to
real
those
quick, Matthias,
banks,
what does pari passu mean? What is that? It's Latin. Is it? What is it? Just tell us what a pari passu loan is. First of all, is it so you got 5 million in SBA, and then what you mentioned the conventional piece? What does the conventional piece look like to get you to the 6 million?
So not being a legal scholar like you, Eric, I don't know the exact Latin definition, but pari passu essentially means that you're coupling the conventional debt over and above the SBA. So you're doing the 5 million plus the conventional on top of it.
Yeah,
5 million plus
effectively it means it means equal in rights. So when you think about traditional debt, if you're layering multiple stacks of debt, there's a hierarchy, and you hear about subordination and things like that. So subordination just means instead of one being higher in the hierarchy, they're equal. So they kind of run parallel in rights and things like that.
Yeah, so the pari passu, the SBA plus conventional is one option at your disposal, Eric. When you get to that level of debt, the debt service coverage requirements increase from what they are with those same banks when you're at or below the 5 million of debt, which would just be through the SBA 7.
Okay, so I'm getting to the $6 million bucks, and obviously there's equity injection considerations, but $5 million in SBA, and then the rest would be a conventional loan on equal footing, so it'd have the same terms and conditions, and it would be side by side with the SBA debt, but a conventional product that you said only some, not very many lenders do this, right? It's a pretty rare product.
There's a good handful of them, and just one segue back to that, Eric. Not all banks that do these will do the same terms and conditions. For some of them, they might want to see the amortization be shorter with the faster burn off to get rid of that conventional exposure. It's just subject to the bank specifically that does it.
How big can I go, Matthias?
And I want
to buy it. Go ahead, Kev.
Yeah, I was about to ask that very question. Yeah.
Yeah. Well, how much can we take?
So
I want to buy a $20 million business. Can I get it?
Yeah. So of the banks I know that do I'd say the upper bound would be 4 million plus minus somewhere in there. I know banks that will do these for hotels that will stretch up to 10 million with the 5 million SBA 7A plus 5 million conventional.
So you said 4 million is what they'll do. You mean 4 million above the SBA 5 million, or what do you mean total?
Yeah.
4 million above the FBA 5 million. So
okay.
5 plus 4, generally speaking, plus minus.
So you could conceivably be doing, if you combine with equity raise, seller financing, etc. I mean, you could conceivably be buying a 10, 11, $12 million business, still using an SBA loan plus a pari passu conventional loan.
Yeah, correct.
So Matthias, before we move on, you mentioned that there's a second way to exceed the $5 million. What is that?
So the second way, Eric, is buying businesses in different NAICS codes or different industries. If you buy an HVAC business and use the full SBA 5 million, you could buy a plumbing company, utilize 5 million there. Then you could buy an e-commerce business, do 5 million there, and kept going down the line. In preface or kind of background for the viewers, I have yet to help a client do 5 million multiple industries, so just to throw that out there. But with the new SBA guidelines, supposedly that's something that you can do.
Got it. And for the audience's benefit, and Kevin, I know you know this cold, but it's the North American Industry Classification System, NAICS, and it is a standard industry categorization that's used throughout. I thought it was a U.S. federal government thing. I actually just learned it's not. It's Canadian, U.S. It's all of North America for industry classifications. But my understanding is that you can finance up to the $5 million multiple times using different NAICS codes. So fascinating.
Fascinating. It'll be interesting to see and keep track of how that plays out, right? It's one of those things that it's hard to know. Is that a mistake? And are they going to catch it and close it? Or are they actually going to allow that to happen? But
believe me, Kevin, there are clients I'm working with now that are working to execute under this new structure.
I love that.
And one deal closes, I will be posting it on Twitter and LinkedIn.
Let's go.
Looking forward to it.
I'm excited. And one thing to note for the audience's benefit is that $5 million cap is lifetime, not lifetime, but in the aggregate, meaning you can have multiple, you could finance $5 million acquisitions using the SBA program. So not a one-time and you're done deal. Matthias, you have visibility to a lot of transactions. You are seeing debt service coverage ratios and you're seeing valuations. And I'm curious what lenders are wanting right now and what you're seeing in terms of debt service coverage ratios and valuation multiples. What are businesses being sold for right now? Start with valuations.
Generally speaking, Eric, I would say it's somewhere between 3 and the low 4s is what I'm seeing on average as far as multiples go. Is that in line with what you guys are typically seeing?
So yes, candidly, with the lending process, or sorry, the legal process, we don't have a ton of visibility to the financial underwriting and the valuations. And it's a question that frankly we should probably ask more often because we have, a tremendous amount of data coming through our firm. My exposure right now is saying that most deals are getting done between like 3.25 and 4. I'm not really seeing
That's
a
what
lot
I
of
would have said, exactly the same range.
Yeah, not really seeing a lot of 5s. I lean fairly heavily, and I'll pull it up on the screen here for the audience's benefit, to this Biz Buy Sell Insight report that's actually pretty good. And as soon as I can find Riverside here, I'll put it on the screen. But this is a helpful little report that Biz Buy Sell puts out quarterly. And they categorize things, and like small business acquisitions grew 2% year over year in Q3, continuing steady gains, yada yada. So I don't think they have their Q4 report yet, which makes sense. And let's see what they're saying on valuation. It says valuations remained flat. The average cash flow multiple sold on businesses declined 1.4%, while average revenue multiple inched up 1%. I would say those small changes to me indicate kind of nothing statistically meaningful. Biz Buy Sell also, the problem with their data, in my opinion, is that they see a lot of very small transactions. I think what we are looking at, both our firm, S&B Law Group, and Pioneer Capital, my guess would be, is what I consider to be like blue chip ETA. People who are going out and buying high quality businesses. Most of them are 500K EBITDA or SDE, but I would actually say the median is probably 750 to 1.5 million. Those are big transactions. This Biz Buy Sell report, like if you look at the average transaction size, median sales price here that they're showing, sales price, asking versus sales price, is 350, asking price against 330 sale price. So they're factoring in a lot of really small transactions. It would be helpful for somebody with a lot of statistical visibility to blue chip ETA like S&B Law Group and Pioneer Capital to put our heads together and actually create a report in the blue chip ETA space. But that's what I'm seeing right now. What do you see, Matthias, on debt service coverage ratios? And for the audience's benefit, a debt service coverage ratio, first of all, define what is a debt service coverage ratio, because I'm going to do a terrible job of it. And then tell us what you're seeing and what lenders want.
Great question, Eric. As far as debt service coverage ratio is defined, essentially it's taking adjusted EBITDA as the numerator in the equation and then dividing that by debt payments. So payments on the bank note, the SBA 7A note, along with payments on the seller's note. If you're doing a deal where it's on a partial standby for the seller's note, with payments starting in year 3 after closing, most banks will exclude that payment from the denominator on the debt service coverage. So the adjusted EBITDA, more or less, is taking the EBITDA of the business and then adding back non-recurring expenses post-acquisition. So essentially, expenses that have run through the business historically. Maybe the seller has been expensing their personal vehicle or similar through the business, and ones that won't be applicable going forward. And then the denominator is the bottom of the fraction, bank loan payments plus seller note payments.
Okay. So you're basically looking at how much money does the business make, or do we anticipate that it will make going forward after adjusting for things that will no longer occur, like if we've got an absentee seller who's paying himself a salary, or if his niece is on the payroll, or if we've got, and also adjustments to the negative, right? Like if we've got a lease payment that's below market because the seller owns the property, you've got to adjust up for that. So basically you're trying to figure out how much money do we think this business is going to make going forward based on what it made in the past, adjusting for changes against the debt payment of the business. And that gives us a number. And that number typically is what, Matthias, and what are the banks looking for?
So the SBA requirement is that it has to be 1.15 or higher, meaning 15% cash flow over debt service. Most banks that I work with want it to be 1.25 or higher, meaning 25% cash flow over debt service, with the most subset cohort of banks being 1.50 or higher, meaning 50% cash flow over debt service.
And what are we seeing buyers actually bringing deals at?
I would say the vast majority of deals I'm seeing are over 1.25 currently, generally speaking.
And how often is that including the standby note? And just to clarify, it's a little bit of a leading question because I'm curious your commentary of are there situations where that partial standby note could be excluded, but you're looking at it thinking maybe that's not the best idea because in year 3 that's going to be tight based on projections for where the business goes. Kind of one of those just because you can, should you type of questions.
Right.
Like how do you factor in that partial standby note when determining the DSCR and whether a deal is advisable or not?
Great. Yeah, phenomenal question, Kevin. Most buyers, when they reach out and they come to me, they aren't modeling in the payments and the partial standby seller's note. What I've been telling people to do is to map out 2 different debt coverages. So if you as the buyer are planning to use the partial standby seller's note to show essentially a row below what the debt service coverage would be when there's no payments on it, to show a fully loaded debt coverage with what debt coverage will be when you have to start making the payments.
Yeah.
But most people, when they approach me, that's not taken into consideration. And also in all honesty, as surprising as it may be for both of you, most banks aren't looking at that. If there's no payments on that partial standby seller's note for at least the first 3 years after closing, due in part to the fact that banks look 3 years out into the projection period typically. So some will do 2, but most do 3.
Yeah.
Interesting.
Yeah.
I think you'd have to be
super
crazy. It's amazing to me, Kevin, that the SBA will approve a deal at 1 1/8 debt service coverage ratio.
Yeah.
And I think you'd have to be out of your mind to buy a business at 1 1/16 or whatever, 1.16. It'd be nuts. And I don't think it would work. I think it's way too skinny. And it's interesting that that's where they've set the bar. I know, and Matthias, your visibility to lenders is much greater than ours, but a lot of the bigger lenders won't approve a deal unless it's north of 1.5. And every bank's different, right? So they've got their different things that they're looking for. Some are looking more heavily at debt service coverage ratio. Some are looking more heavily at you and your transferable skills. And so, it's not all quantitative. There's a lot of qualitative breakdown in the credit guidelines, but that's surprising to me, Matthias. I did not know that the SOPs will allow it down to 1 1/8. Would you buy a business at 1 1/8, Matthias?
Phenomenal question, Eric. I personally would not.
There you have it. Perfect.
I
Perfect
tend
answer,
to
Matthias.
start businesses instead of buying them.
What's the movie Old School where Will Ferrell is debating against James Carville on like a political science question, and he like blacks out and he like gives the perfect answer, and James Carville's like, "It's perfect. I've got no response." So beautifully said, Matthias.
I need to watch the movie Old School again. It's been a hot minute, Eric.
Matthias, let's close with talking about working capital in these deals, because I think that's such an important issue. And obviously, from the lending perspective, from the legal perspective, the business perspective, working capital for the audience's benefit is the money, the AR, and the inventory, the stuff, the grease in the wheels of the business, or the gas in the tank, or the tires on the car, whatever analogy, the blood in the body. It's what keeps the business going.
Keep it going.
Right?
Keep rolling.
Oh, I've got analogies on this.
The cheese on the pizza.
It's the cheese.
I'd say it's the coal in the pizza oven, Matthias.
The coal in the pizza. Okay.
It's what greases the wheel. So you close on an acquisition and you immediately have to make payroll, right? You've got employees that are expecting you to send them cash that Friday, or you close on an e-commerce business and you've got customers that are expecting you to mail them products. If you close on a business that's got employees and contracts and office furniture and a bunch of stuff, but it doesn't have any cash, you're going to find yourself in a little bit of a pickle shortly after closing. And so in most sophisticated M&A transactions, small business M&A transaction, you'll negotiate working capital. It's a part of the business. In the absence of that asset, the business doesn't operate. So the valuation, the whole philosophical valuation and what you're buying is undermined. So in most instances, you get that. The problem is in small business M&A, you oftentimes run into brick walls with sellers and sellers counsel and sellers advisors who don't appreciate that, understand it, or get it because it's their world and we're just living in it. We're just lucky to be there buying their amazing, world-changing fencing company. Yeah. And so they'll say working capital, Matthias, sounds like a you problem, right? And now I'm buying a business. I got to figure out, again, we talked about personal financial statements and the like. I got to figure out how I'm going to close on this business and then make payroll and do the things that the business needs in the normalized course after closing. Talk to us about financing working capital. You mentioned it as a part of the sources and uses. I'm also familiar with an SBA lending product called an express loan. Tell us about the various, and I have a follow-up to that, but I'll stop there because obviously this is long-winded, but tell us about working capital financing, Matthias.
So there are three ways that you can get working capital into a deal, Eric, one of which you mentioned during the question is a segue leading up to it, which is having it negotiated into the purchase price. So basically establishing in the letter of intent that you're going to have a normalized level of working capital, including the purchase, which could be a combination of cash, accounts receivable, inventory, and there are different schools of thought as to how to arrive at that number. Some people decide to put it to the quality of earnings report and basically kick the ball down the road to the ninth inning. I generally don't encourage that, not legal. You can also have a minimum range or like a minimum number and then mention that it will be firmed up in the QB, or you could have a range. The other ways that you can get working capital into the deal is you can have it financed into the SBA 7A acquisition loan. Generally speaking, most of the banks that I work with or have worked with don't want to finance more than the buyer group is putting as a down payment into the deal, with the rationale being that if the SBA audits the file, it will basically look like the bank just gave the down payment back to the buyer group, if that makes sense. The third way in which you can get working capital into the deal, back to the question that you asked, Eric, is there's that product called the SBA Express Line of Credit, which is essentially a revolving working capital debt facility on which you make interest-only payments based on the amount drawn. And then in years 4 through year 10, generally speaking, after the revolving period ends, during that point in time, you pay down the principal balance as it amortizes based on the amount drawn during that. And adjacent comment to that before you pop in, Kevin, is those facilities go up to $500,000. The amount of the facility depends on the working capital needs of the business.
Yeah, so the bank will kind of offer what they think the right level is. How does that factor, if at all, into the DSCR calculation? Assuming it's undrawn at closing, is it not factored in, or does the bank take into account that loan capacity as if it's fully or partially drawn when determining the DSCR for the deal?
It would be the second or the latter. Banks will look at if it were fully drawn, what the impact on debt coverage would be.
Got it. So it's looked at just like the 7A loan fully drawn as the full debt, the full amount of debt service for. Okay.
That's correct. And one adjacent comment to mention for the benefit of the viewers or listeners is that facility impacts that 5 million calculation. So if you're looking to take it at $500,000 express line of credit, you can only do 4.5 million to collectively total to 5 million on the SBA 7A acquisition loan. So 4.5 plus $500,000 equals 5.
And break that down on the deals you're seeing, Matthias. How often are you seeing one over the other? How often are buyers bringing you deals where they've negotiated a solid level of working capital to run the business into the purchase price versus are needing to actually finance it through the SBA loan?
Most buyers, generally speaking, the subset that we kind of see on SB Twitter and similar, most typically have in their letter of intent that they're requesting to include normalized level of working capital. Some of them will kind of go into more detail in the LOI as to what they're expecting there, if it's a range or minimum to be firmed up in the QB. I'd say it's more few and far between, Kevin, when there is no working capital expectation in the LOI. I don't know
Yep.
if that mirrors up with what both you and Eric see, but I'd say it's more of a rarity typically when it's
Yeah.
completely foregone altogether. And just to throw you guys a plug back, that's generally why I tell buyers before submitting the LOI to consult with legal counsel to make sure that you don't miss anything major such as that.
Yeah.
Well, and it's a tough issue, right? Because when I go to buy a pool installation business, right, they're building pools. It's really capital intensive. You need a lot of money up front to install pools. And I take that deal to a lender and I'm getting the lender to approve it. And they've got concerns about the working capital. But at this point in time, all I have from the seller really is that 3 years of tax returns that you mentioned and the personal financial statements. It's tough to figure out what this business is going to need in the normal course. And so it's a really tricky issue in small business M&A when you've got a working capital intensive business like many of these, like asphalt paving or, tree trimming. You need big machines. So Matthias, one of the biggest things that I see, I think it's a mistake, frankly, that I see a lot of buyers make in the SBA vetting process is over prioritizing interest rate, right? And we're also, and it's important, right? I mean, you're going to financially underwrite a transaction. You're thinking about your debt service and how expensive it can be. I see buyers over prioritize interest rate. I see them over prioritize a few lenders who have fixed rate products. Talk to us about what a buyer should be looking for when they choose a lender.
Great question, Eric. The first and most important thing that I think is the experience of the lender, how long they have been at their current institution, or kind of more generally in SBA search fund cash flow lending to begin with. And then also what their conversion rate is from term sheet delivery to approval. I think those are the most important factors.
And how do you, so I think what you're saying is certainty to close with the second part. And how do I make sure,
100%.
I had a client a year or so ago and he went to a big national lender directly and his files sat on this lender's desk for like 2+ months, like crazy. And finally, in the end, the lender picks up the file and starts asking all these questions that the buyer's like, what the heck's going on? Like, these are questions you should have asked 2 months ago, And at this point, his deal's in jeopardy as a result of it. How do I know that that's not going to happen? You said diligence for the pull-through rates. How do I do that?
You can ask for references from people like yourself or other service providers in the space. You can ask the lender directly if they can put you as the buyer in touch with former clients that they've worked with to share their experiences if they're willing to do that. Of course, with bank confidentiality guidelines that may or may not be challenging. And you can just ask the lender directly what their pull-through rate is, and generally speaking, what portion of deals that they issue term sheets for ultimately get approved.
And that's part of what you as a broker would do, I think, is alleviate a lot of that like extra make work for searchers to stay on top of bankers, right? Because at the end of the day, I think if you do end up with a lender like Eric's referring to, unfortunately, you happen to have a bad closer, whoever's running the file, it's the person that's constantly following up, that's hounding the bank, that's like, what else do you need? What else do you need from me? Let's get on the phone tomorrow. That's what's ultimately going to drive that deal through, right? Is kind of that tenacity and perseverance.
Correct. Yeah, 100%.
Yeah.
All right, Matthias, this was fun. What final words, and feel free to plug Pioneer Capital and anything else that you're working on, where we can find you.
Final words or plug from my side is that if you're a business buyer, either in the early stages of the search process or further along that is approaching a deal, looking for financing with a debt need of $1 million or higher, I would definitely love to help you. Basically, as Eric mentioned towards the start of this podcast, I cost nothing to work with since I get paid directly by the bank. And essentially, my sole goal is to help facilitate a smooth process start to finish for the financing.
All right.
Awesome.
Matthias, thanks for coming on, man. That was fun.
Yep. Always a
Thanks
pleasure.
for having me, guys. It was good chatting with you.
Thanks for listening to this episode of Mundane Millionaires. If you enjoyed what you heard in this episode, make sure to follow Mundane Millionaires wherever you listen to your favorite podcasts. See you next time.